Hi, and welcome back to the Food Fund, where we analyze investing in food, beverage, and restaurant stocks. Is the internet's most popular steakhouse stock a good investment? In this video, we will be analyzing if Texas Roadhouse stock is a buy. Can Texas Roadhouse, stock ticker symbol TXRH, move even higher? Let's find out. We have so much to cover, so let's go ahead and jump right in. Cue the logo. Let's start off with the price action. Looking at the one-year chart, we see that Texas Roadhouse had a CAGR of about 11%. Zooming out to the 5-year chart, we see that Texas Roadhouse had a CAGR of 31%. Texas Roadhouse has been a big gainer over the long term, but has been rising a bit more slowly as of late. Now let's hop over to market share and take a look at Texas Roadhouse's market share. Here we have the dashboard, where we can quickly gather a lot of information at a glance. Expanding the dashboard, we can look under restaurants and see that Texas Roadhouse is categorized as a casual restaurant company. Expanding the casual restaurant tab, we can see that Texas Roadhouse has the second largest market share of the companies in this category. Even better is that the green color indicates that the company is growing its market share. Let's look closer at the year-by-year changes in market share. So we come down here and type in the ticker symbol for Texas Roadhouse TXRH and see that the market share is 0.66% out of the publicly traded food, beverage, and restaurant stocks currently in the market. There is a good amount of spend on Texas Roadhouse, and it has been increasing over time. The 5-year market share CAGR for Texas Roadhouse is 10.88%. This means the Texas Roadhouse has gained market share over the past 5 years. If we start in 2021, we see that the market share was 0.48%, 0.5% in 2022, 0.56% in 2023, 0.65% in 2024, and 0.66% over the trailing 12 months. Though the market share has increased over the past 5 years, the rate of growth has slowed tremendously since 2024. Is this the canary in the coal mine? Let's take a look at the fundamentals to learn more. Gross margin is 19%. This is on par with other casual restaurants. Revenue has compounded at around 15% over the past 5 years and has grown to $5.5 billion most recently. Clearly, customers love Texas Roadhouse and continue to visit, time and time again. This is what you want to see in your portfolio companies. When we look at cash flow, we see that operating cash flow has improved at a 15% CAGR over the last 5 years. CapEx has worsened at a 19% CAGR. As a result, free cash flow has also improved at a 13% CAGR during this time period. Management has continued to grow free cash flow while investing in building new restaurants. This is the secret sauce to being a successful restaurant company. Weighted average shares outstanding have decreased dramatically over the last 5 years, going from 70.1 million shares in 2021 to 66.9 million shares most recently. Texas Roadhouse has been doing a great job buying back shares. By retiring a little over 1% of shares each year, Texas Roadhouse is increasing the slice of the pie that investors own, putting more earnings and dividends in their pockets. Now let's view return on invested capital. Return on invested capital has improved from 11.7% in 2021 to 14.7% most recently. Texas Roadhouse continues to do a great job of growing returns on capital used for invested. I do not expect this trend to reverse anytime soon. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage, as well as inventory control. Going from 7 days in 2021 to -5 days most recently, Texas Roadhouse has finally crossed over into the promised land of negative cash conversion cycle. The negative value here means that Texas Roadhouse has about 5 days between the time they get paid by customers and the time they have to pay suppliers. They can collect interest on this cash or use it to further improve the company. Again, this is the hallmark of a great restaurant company. Now let's look at Texas Roadhouse's debt. The net debt to EBITDA has decreased over time, going from 1 in 2021 to 1 most recently. This is beautiful. Texas Roadhouse is still supercharging growth at the company by using leverage, but at levels with minimal risk of defaulting. Last, let's compare performance to the benchmark. If we perform a backtest comparison of investing $10,000 in Texas Roadhouse versus the S&P 500, we find strong performance for Texas Roadhouse. In that comparison with the S&P 500, $10,000 invested in Texas Roadhouse would have grown to $61,227 versus $35,579 if invested in the S&P 500. This is an annualized return of 21.01% for Texas Roadhouse versus 14.29% for the S&P 500. A Texas Roadhouse investment would have been more volatile with a 27.18% standard deviation versus 15.44% for the S&P 500. However, Texas Roadhouse outperformed the S&P 500 in terms of the best year performance, for which Texas Roadhouse grew 49.75% versus S&P 500 31.22%, and even the worst year performance where Texas Roadhouse fell just 3.63% versus the S&P 500 18.17% fall. In terms of max drawdown, Texas Roadhouse fell 38.42%, more than the max drawdown of 23.93% for the S&P 500. Texas Roadhouse performed comparably to the S&P 500 in comparisons, using the Sharpe ratio and the Sortino ratio. The Sharpe ratio for Texas Roadhouse was 0.77 versus 0.81 for the S&P 500, but the Sortino ratio was 1.27 versus 1.26 for the S&P 500. While more volatile, Texas Roadhouse has largely outperformed the S&P 500 by several key metrics. Texas Roadhouse is a very fundamentally sound company. In any event, is it a buy? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Texas Roadhouse. It is a restaurant company with a gross margin of 19%. The 5-year revenue per share CAGR is 17%, and the 5-year free cash flow per share CAGR is 14%. The good gross margin and strong revenue and free cash flows are great. A return on invested capital of 15% is great, and getting even better. Next, the cash conversion cycle of -5 days is outstanding, and highlights just how great this company is. Concerning debt, a net debt to EBITDA of 1 means that Texas Roadhouse could pay off their debt with 1 year of earnings. So from a fundamental standpoint, Texas Roadhouse is about as good as they come. Now let's switch our attention over to valuation. The price to earnings growth, or PEG ratio, is 3.1, indicating that Texas Roadhouse is overvalued relative to their projected earnings growth. Texas Roadhouse was founded on February 17, 1993, by Kent Taylor, who opened the first location in Clarksville, Indiana. Today, Texas Roadhouse has grown significantly, operating hundreds of locations across the country and internationally, with a workforce of approximately 95,000. The company offers tasty steaks, sides, and sweet desserts and maintains its headquarters in Louisville, Kentucky. The tasty menu at Texas Roadhouse isn't just about good food, it's a huge competitive advantage. Customers love Texas Roadhouse, and that loyalty translates into consistent customer traffic, which is gold in the restaurant business. The cash flow growth and strong balance sheet make this a great company to hold in a portfolio, and they are only getting better. Texas Roadhouse has a fantastic brand, a loyal customer base, and a sound financial footing, making it a compelling consideration for many investors. Overall, I give this company a 9 out of 10 using my proprietary scoring system. I like Texas Roadhouse a lot, and will look to add to my position anytime I can. Many thanks for watching. What do you think about Texas Roadhouse? Share your thoughts below. It is always great to hear from you. Check out some more videos right now, and don't forget to put your money where your mouth is.